Good afternoon, ladies and gentlemen. Please be seated. The event's about to start. We have a very short time for lunch, a total of 40 minutes. It's deducting another 5 minutes. Thank you very much for coming today. We have a number of you very interested in the topic of China. So today, I am representing AmCham. I am a co-chair of the AmCham China Business Committee. My name is Lily Zhang. I'm also the co-chair for AmCham Select USA Committee. I am a partner or managing director at Deloitte Asia Pacific International Core of Excellence, whereby we pull 15 countries to Hong Kong to serve clients making cross-border investments. So without further ado, a few logistics matters. For those who are in gray badges, these are the non-members. Everybody else are members. So I hope you find today's event informative and that you would like to join us for all future AmCham events and become a member. And for now, let me make a brief introduction of the head table. We have Jing Ulrich. She is here, just outside, probably. We will have a short introduction of her later. And we have John Dawson right here, and he will be moderating today's discussion. And then next to him is Seth Peterson. He's a governor at AmCham, also a partner at Hedrick and Strackles Hong Kong Limited. Next to him, we have Geir Peters, Group Director and Chief Financial Officer of CLP Holdings Limited. Next to him, we have Garrick Incledon, CEO Asia Pacific Hugo Boss Limited. Ivan Strunen, who is the AmCham Tax Committee Chair, also Managing Director at Deloitte APIs. Very appropriate. Vivian Kwok, Editor-in-Chief and Associate Publisher at Bloomberg Business Week, Chinese modern media. With that short introduction, please turn off your phones and other electronic devices that will make noise. Please enjoy your dinner and your table mates, and we will come back in about 35 minutes. Thank you. Well, I hope everyone has enjoyed your quick lunch. While you're enjoying the dessert, I'm going to make some short introductions of Jing Ulrich and John Dawson. And I will start with Jing. Actually, she is someone that requires no introduction for many. For those who do not know her, I just want to give a brief introduction. She's a managing director and vice chairman of Asia Pacific at JP Morgan Chase & Company. She serves the firm's most senior global clients across all sectors and all asset class, while building relationships with executives in Asia Pacific's leading enterprises and policymakers. Educated in Harvard and Stanford, she's one of the most prominent advisors to the world's largest asset management companies, sovereign wealth funds, and multinational corporations. Her views influence the allocation of trillions of dollars of assets. So today, I want to find out for myself where I should invest. But I should leave that to John Dawson, who will be moderating today. I'd like to make a short introduction of him as well. He's a director at Artemis Associates. The firm is a leading communications consultancy firm, was voted the new consultancy firm in Asia by Holmes Report in 2013. John joined the firm after 20 years of his career at Bloomberg Television, where he was the primetime anchor in Europe and Asia, interviewing the world leaders in industry and politics. He is also an in-demand conference moderator, speaker, chairing numerous conferences and panels and reports from these conferences, including the World Economic Forum in Davos, as well as politically charged OPEC meetings. Now, I would say these two and I have something in common. With Jing, I can tell you that she wears an Apple Watch. Except for me, it only shows about 2 miles, and for her, it shows 25 kilometers, probably. And for John, he doesn't know. The thing we have in common was that we both arrived in Hong Kong in 2010, with the exception that he found Lan Kwai Fong many times, and I still do not know how to get there. So if you notice, he's very gracious. He wears socks to Jing's preference and ties to my blue color tone. So right now, he luckily does not have to sprint to run after Jing. He can moderate her right here, and he had nothing to drink. So he would ask brilliant questions. And with that short introduction, please let's welcome Jing and John.
I can't believe I got an introduction with LKF in it. Thank you very much for having me. Look at the audience, extraordinary, fantastic. AmCham, William, Seth, and Richard is not here. Lily, of course, with the introduction. Negating the LKF element. I have not been to LKF, just contrary to speculation, for quite some time. Although Wyndham Street is a bit more attractive. Jing and I, as you were saying, have certain things in common. Jing, usually, we've interviewed each other, well, I've interviewed you on TV lucky 8 times. So it's usually 4 minutes, now we have a bit longer, which is fantastic. Also, Jing and I share an English degree, and Jing loves socks, not wearing them, but I wore my special socks for Jing today. So there you go.
You have to tell people the story. We talked about these socks on TV, and they went viral afterwards.
A friend of mine has a socks company quickly called SOXKS, and he said, I dare you to toot this. So I brought them on, I pulled them out, and they had the Year of the Ram, the sheep. And Jing said, these are fantastic, and that went viral over social media. Never mind the China's economy slowing down, the socks were the headline. But it's great to be here, seriously, and Jing, it's always an honor, always a great honor. Just to add to that, Lily, that Jing 2006 was the AmCham Young Achiever of the Year. Finance Asia in 2012, the top 20 women in finance in China 2013, Fortune top 50 most powerful global businesswomen, and in 2014 Forbes came out the top 10 of Chinese power women. So you've got a very good, and it's clearly all about relationships for Jing. So there'll be a lot about asking about the Chinese economy, but what they're telling you. So let's just quickly start, if I can, just to update on figures on China. So we had figures, exports were down 3.7%, August was worse at 5.5%. Imports slid for 11th month in a row, down almost 18%. On Monday coming up, we have the GDP for the third quarter. The forecasts are average 6.7%. ANZ is the lowest with 6.4%, and the highest is SocGen Morgan Stanley, 6.9%. In 2010, of course, it was 10%. So Jing, where are we now, bearing all this in mind? Everyone's concerned about, we've got the 5th plenum coming up, discuss that later on. Where are we now? The red flags that concern you the most, what your clients are telling you, the bright spots, what's your take?
Okay, thank you, John. Lily, thank you very much for the kind introduction. I'm always very happy to be back at AmCham events. I think every year in the past, 10 years, I've addressed AmCham audiences every single year. It's always a great pleasure to see everyone here. So a very warm welcome. And also to all the friends from the press and media in Hong Kong, a very warm welcome. So now let's get to it. What's happening to the Chinese economy? Just this morning, when you turn on, I just got back to Hong Kong early morning, turning on the TV, what's happening? Imports are down 20%, exports are down 3.7%, and then today the market is not having a good day because everyone's concerned about the slowing down in China. Well, when you look at some of the numbers that come out on a monthly basis, the high frequency data, clearly there are some reasons for concern. Just a couple of days ago, we had the inflation numbers coming out. We had China's producer price index down by pretty wide margin, 5.9%. What this means is that if you're producing steel, cement for the industrial sector, your prices are dropping by 5.9%. And importantly, this was the 46th month in a row that producer price was dropping. CPI numbers were also quite low, 1.6%, and that actually thanks to pork. Pork prices actually were quite stable, therefore CPI hasn't dipped into negative territory. So when you look at all these high-frequency economic data, people are wondering, gee, what's really happening to the Chinese economy? And by extension, what's happening to the global economy? I think it's important to keep in mind where the double-digit growth era is long behind us. You know, if you think back on 2007, the year before the financial crisis, China's GDP growth in that year was 14.2%. Today, according to government numbers, it's 7%. So in the last 7 years, growth rates basically have halved. So on paper, on the surface, this is a cause for concern. But I think there's some underlying factors that we really need to go into to understand why growth is slowing. Actually, are there some brighter spots? Just take today's numbers, for example. I know a lot of the friends from the press are interested in knowing why imports and exports dropping so much. Well, what China imports these days is basically commodities, you know, oil, iron ore, coking coal, agricultural commodities, and all these prices have dropped so much compared to the same period last year. Volumes are dropping, but prices are dropping even more. So therefore, we had import data pointing to a pretty negative picture. In terms of exports, export numbers are down also for the last month. In fact, they've been down for the last few months. But what's interesting is that you have the net export figure, which gives you the trade surplus, right? That's nearly at an all-time high, $60 billion. So what's happening is China's importing less, and the items that China imports have seen prices drop rather precipitously. So that's why you have the 20% drop number that we have. But ironically, net exports are actually contributing positively to growth because the trade surplus is bigger because of the collapse of imports. And because the trade surplus is bigger, and in the near term, again, it is quite an irony. It is helping support the level of the RMB. We can go into a bit more detail on all these, John.
Do you think that the devaluation on this was a reactive or proactive approach? Was it a bit of panic with the government, central bank, or not?
Well, I actually remember August 11th was a day when suddenly the RMB's daily fixing rate dropped by some 2%, right? That took the market by surprise. But actually, I think the market actually misinterpreted the intention of the central bank. The central bank's intention was not to boost exports by devaluing the RMB. In fact, a 2% devaluation would not help support exports so much. And in fact, you know, a larger drop in the RMB value would actually trigger a region-wide devaluation, therefore defeating the purpose of supporting China's exports. I think the real intention behind the devaluation on August 11th was actually to bring the RMB much more in line with market rates. Remember, over the last 12 months, the RMB actually appreciated in real terms by 15% against a basket of currencies from China's trading partners. So, during the summer, if you see other currencies around the region, the Japanese yen, the Korean won, the Indonesian rupiah, everything dropped against the US dollar. The euro, of course, in the last 1 year had weakened against the US dollar. Only the RMB was quite steady trading against the US dollar. So the central bank in China was hoping to bring the RMB much more in line with real market rates. Also, China's leadership is very keen for the RMB to be included in the IMF SDR basket, the special drawing rights basket. It's not in yet. Hopefully by next year it will be included. So I think the leadership tries to make the RMB exchange rate much more market driven. But in the first few days after the devaluation on August 11th, the market dropped yet again, another 2%, another 3%. So triggering a sense of panic in the market. But actually, the intention was actually misinterpreted, I think, by the market initially.
So how do we stand now? Because do you think the market overreacted? And is there now balance? Because, Christine Lagarde talked about in the recent fairly gloomy IMF report that China's slowdown is healthy and it's moderate, quite upbeat, and kept her forecasts. I mean, do you think that she's right, for example, and that actually they're on the right track, or do you see a lot of red flags?
Well, there are bright spots, there are red flags. As always, in an economy as complex, as large as China's. But we need to understand not just the actual growth rate, whether it's 7% or 6.5%, that's not the most important thing. The most important thing is where the growth is actually coming from. You have many investors and corporate managers sitting in the audience here. No one can invest in China's GDP per se. From many years ago, I remember one of my clients asked me, China's GDP is so robust, growing 10% a year. Jing, can you somehow come up with a derivative that just track China's GDP? I can make 10% a year. I'm sorry, there's no such thing. We all invest in businesses. We invest in companies. We invest in factories and plants. We invest in distribution, right? So you need to find pockets of growth in the economy where you can put your money and generate healthy returns rather than investing in the general economy, right? And of course, many sectors growth tracks that of the GDP growth. So I think for us here, the most important thing to understand is where the growth is actually coming from. So China has 3 growth drivers. It's plain and simple. Net exports, number 1, we mentioned that before. Number 2, investments. And number 3, consumption. Only 3 drivers for GDP. It's very simple. So let's start from the smallest contributor, which is net exports. I said earlier, imports have collapsed. Exports are still dropping, but imports are dropping by a much larger amount. So what's happening then is exports in this year are contributing positively to growth, but only marginally. So if GDP growth is 7%, net exports are probably contributing 0.5% to the GDP, right? So then that leaves us with investments and consumption. So when people say investments, people ask me what that means. It's very simple. Investments have 3 parts. Infrastructure investments, investments in real estate, and investment in manufacturing. So John, you're a very astute observer, very astute financial market analyst. So of the 3 parts, infrastructure, real estate, and manufacturing, which investment area is actually growing in this year?
Not real estate.
Correct?
No. I would say infrastructure.
Correct. I'm interviewing you now.
A plus on my economics paper.
So exactly right. So when you look at investments, that's still the largest chunk of GDP, right? 45%, 48% GDP is actually investments. And that has 3 parts. Investments in real estate is now growing. Why not growing? It's very simple, because we have been in a downturn in the property market for probably 2 years now. So a lot of the developers have a lot of inventory, unsold housing. We've had a small recovery in the housing market, but in the last few months, the developers are basically trying their best to sell unsold inventory rather than buying land to build more housing, right? So this makes perfect sense. So investments in real estate usually have a lag. Between the recovery of the market and investment, there's usually a 9-month lag. So maybe sometime in 2016, we will have a recovery in investment real estate, but not right now. Investment in manufacturing also is dropping. That is because in the manufacturing industry, you can think about steel making, aluminum smelting, cement production, solar panel production. A lot of these industries are actually mired in overcapacity and heavy debt loads. So therefore, they cannot invest in more capacity. So investment in manufacturing is also not growing. The bright spot here is investment in infrastructure. This is where the central government can use its fiscal power, fiscal tools, to try and channel investments. So in the last, I would say, 1 year, you have had a concerted effort on the part of Beijing to invest more in not just airports, high-speed rail anymore. They're beginning to invest in more underground infrastructure, pipelines, for example, sewage system, things you don't see, but things that are critically important. So this is a bright spot. Year to date, investments in infrastructure are actually growing by nearly 20%. So out of this big part of GDP, which is investments, the only big driver of growth is investments in infrastructure.
Is that going to be consistent, and do you therefore recommend that they allocate capital and investments towards this infrastructure area?
Well, infrastructure by definition,
20% is a huge growth.
It's a huge growth. But remember, investments do not equal. Investments don't exactly translate exactly into returns. You can put money in, that's generating growth, but the returns are another matter. Just another thing, John, just to test your knowledge on the economy.
This is terrifying. Jing Ulrich's interviewing me.
So when you go home, you're always a nice man, wash your own clothes. Are you generating GDP?
By washing my own clothes?
Yeah.
I guess I'm buying washing powder, electricity for the washing machine.
No, the action of washing your clothes, not counting the input.
No.
No, that's right. But if you hire
was an easy
someone,
question.
if you hire someone
Okay,
to
let's
wash your
follow it up.
clothes, if
Let's
you
check-
hire
let's
someone
go.
to wash your clothes,
Right.
you're generating GDP,
Yeah, because
right?
your employment.
Exactly right. Yeah. So when your activity doesn't equal returns, right? Investments in infrastructure can actually generate GDP in that 1 year, but the returns in infrastructure investments tend to be longer term. You build a bridge, traffic will not come immediately, right? It's going to take months to build up the traffic. You build a tunnel the same way. Airports, you have the initial phase of the infrastructure not generating any returns. So yes, infrastructure investments for the long term are a good area to put money into, but you have to be a long-term investor. Don't hope for returns in the next 3 months. So now we've talked about net exports, we've talked about investments. The most important part, and I think that's everyone's also interested in, the part of GDP that's driving growth going forward is consumption. So consumption is
That's the goal of the new government.
that's
to
a
drive
goal
it
of
by
that's called
consumption,
the economic
as opposed to-
rebalancing, right?
Exactly right. That's the whole.
So consumption, unfortunately, we don't have the monthly economic number on consumption growth. We don't know how fast consumption is growing. And until year end, you get the numbers from the National Statistical Bureau. So the only rough gauge we have on how fast consumption is growing is retail sales. So retail sales numbers come out every single month, roughly the 10th, 11th of every month, you have the retail sales figure. And year to date, retail sales in China have grown by 10% a year. So in the US, it's growing 0.5%, right? So the 10% number is actually quite remarkable. But I always believe in digging into the numbers. That's why I interview a lot of people. They call me the Oprah Winfrey of the investment world, just because I interview a lot of people to really get a sense, to get a sense of what's happening. So retail sales are growing 10%. Then you have so many different segments, right? You've got the fast-moving consumer goods for the mass market. You've got luxury goods. You've got things that people are buying for daily consumables, right? What's growing fast? You have got different channels. You've got bricks and mortar, you've got e-commerce. So you really need to understand which segments are growing the fastest, which segments are growing the slowest, so that you don't invest in the wrong areas. So retail sales growing 10% this year. E-commerce so far this year has grown by 37%. And e-commerce now accounts for 9.8% of China's overall retail. So this is a very, very fast-growing segment of the Chinese economy. And if you look at consumption overall, I would say consumption has held up very well despite the slowdown in the economy. I mentioned earlier, if GDP growth is 7%, net exports are contributing 0.5%. Investments are only contributing 2.6%. The rest is consumption. So consumption now has become the single most important driver for China's economic growth. And this is so important. It wasn't the case only a few years ago.
The caveat there is that, for example, during the parade, where did all the Chinese shoppers go? Japan.
Well,
The
just to
yen is
test
big.
your knowledge
So
on the
it's true,
economics.
Right? They did go. So
Yeah.
the sophisticated consumer is now looking beyond China
Beyond
to
China,
shop.
yeah. But when they go to Japan to shop, when they go to Italy, France to shop, are they contributing to China's GDP growth? Yes or no?
Yes, they are to buy tickets, but inadvertently they are, but not directly.
No, it's helping the Japanese economy.
Of course it is. Inadvertently, hence the yen
yeah.
is weak, and they're driving the currencies lower. I mean, do you,
Yeah.
just put quickly on this, do you think
Yeah.
there's a currency war going on? Or is that too controversial to talk about? Because clearly the one's driving the yen lower, you can argue that the yuan has been driven lower, so on and so forth.
Well, there's
The
been
euro-
QE everywhere around the world, right?
Yeah.
In some cases, QE has worked. Even Mario Draghi, the ECB president, has said, QE in Europe has worked better than expected. Certainly Japan, which was stuck in deflation, slowing growth for a long time, had no other way to get out of the slump but printing money, right?
But with that
Yeah.
comes that magic word debt, which China, of course, they should talk about China debt. So how big a concern is the debt issue?
Yeah, it's an
that's
issue.
a huge
Yeah.
red flag.
Let's
right?
wrap up on this consumer issue, and then we come to debt, right? Debt has always many different nuances. People say, "Oh, debt is a big worry." It's just that we have to really study what debt is a big worry. So on the consumer side, okay, we just want to clarify this. When Chinese consumers go overseas to buy the Prada handbag, the Louis Vuitton
suit.
outfit, the Zegna suit, they're not really the Hugo Boss
Hugo
outfits.
Boss, sorry. Hugo Boss. My client's Xenia. She's on the board of Xenia. What can I do?
Yeah.
Hugo Boss
so
suits as
they're
well.
not really contributing to China's GDP, right? But this is a phenomenon that's going to continue. In 2014, 107 million people from China traveled overseas. Hong Kong had 42 million people come to Hong Kong from the mainland. It's really remarkable. That's why the Hong Kong economy, frankly, in the recent years have been booming, really largely thanks to the huge influx of mainland tourists. So we can imagine 107
And
million
Macau,
people.
right?
And Macau. Macau had 30 million. Yeah, and most of these people that come to Hong Kong, they take the ferry over to Macau, so it's one trip, right? So when they buy goods overseas, they're not contributing to China's GDP. So the Chinese government obviously wants to keep more of the spending in China, but for luxury goods, because of various layers of taxes, mainland China is much more expensive compared to the place of origin. If you buy Hugo Boss, Germany perhaps is the best place because that's the place of origin. You buy Zegna, you go to Italy, that's the place of origin. You buy a Cartier watch, you buy a Mont Blanc pen, you go to Switzerland or France, that's the place of origin, right? It's much cheaper.
And the euro is weaker.
And the euro is weaker as well. So in Japan, of course, provides a very nice travel experience, given the good food, the good environment, very courteous people. So Chinese people love it. So just over the Golden Week holiday, October 1st to 7th, 4 million people traveled overseas. A lot of them went actually to Japan. And interestingly enough, we cannot focus too much just on the overseas travelers. By and large, most people stay in China, right? So during the Golden Week holiday, the amount of money Chinese people spend on restaurants and retail, guess how much? I thought you did your homework.
There's homework and then there's that. I have absolutely no idea.
Yeah, so 1.07 trillion RMB.
Trillion.
Trillion.
Okay, right.
So that's, you don't have to remember all these numbers.
I remember
but
that one.
You can remember it is the size of the GDP of Kuwait for the entire year of 2014.
And where were they spending it?
Restaurants,
Not
travel.
Hong Kong.
No, this is just in mainland China.
Yeah,
Yeah, this
right.
is according to the Ministry of Commerce.
Are you surprised
Yeah.
by that figure then?
Well, it's very high. Very high.
Are you surprised by how high it is? Because I'm surprised.
Well, I had to look at everything.
I'm completely shocked.
But you cannot just look at one number and say, I'm surprised. You have to ask the context. How fast it's grown, right?
Okay.
So the magnitude of the growth was remarkable, was over 20%. So in the last several years, when they began tracking these Golden Week holiday spending numbers, these numbers have been going up. So that really tells us there's still a lot of consumers that are willing to spend, have a good time, enjoy life, right?
Can I ask about Hong Kong then? Because clearly Hong Kong is suffering.
Right.
How bad is it going to be? How bad is it?
I've been although I'm not from Hong Kong, I've been working in Hong Kong for many years. My first assignment in Hong Kong was 1996. So on and off, New York, Hong Kong, New York, Hong Kong, I've been here for a very long time. So Hong Kong really is partially my home. I've seen how Hong Kong adjusts to different challenges. Remember the Asian financial crisis back in 97, 98. Hong Kong had the only currency that was pegged to the US dollar. On July 2nd of 1997, we had the collapse of the Thai baht, and then all the other currencies went downhill, right? So how Hong Kong adjusted in the ensuing several years was rather painful, but Hong Kong adjusted. Hong Kong adjusted by not touching the currency because you can't touch the peg. Hong Kong adjusted by having deflation. Hong Kong had 5.5 years of deflation, if you all remember, from 97 onwards, right? And property prices dropped by half. But Hong Kong came out of it, in better shape. But now the challenges we're facing are slightly different. Because of the last many years, so many mainland people travel to Hong Kong to shop, to eat, to buy property. Actually, the other thing they buy is what? Not just handbags and apparel and watches. What else do they buy?
Cars? I have no idea. Again.
They go to Lan Kwai Fong as you do.
I don't go to Lan Kwai Fong.
He's trying to save his reputation.
There's some great bars in Sheung I can recommend. Very behind the scenes.
They buy insurance policies.
Okay, well.
Talk to all the insurance companies here. They come to Hong Kong, they buy insurance policies, life insurance, health insurance. It's really quite amazing. Yeah.
And how has that changed? How is that changing?
They buy properties as well.
How is the playing field shifting?
Well, now
goalposts?
Hong Kong is expensive because of the peg to the US dollar, right? Hong Kong's rents are high as well. Hong Kong property values are also extraordinarily high. So mainland travelers, mainland shoppers are very astute. They compare prices online when they buy apparel. They also compare prices when they buy other products, financial services or otherwise, right? So now you have, over the Golden Week holiday, the number of travelers to Hong Kong actually went up, but per capita spending has gone down. And if you're a retailer, you would say the quality of the travelers is coming down because they're spending less. So you have more day trippers who come across Luohu, Shenzhen to Hong Kong. They go to a supermarket, buy a tin of milk powder, they go home.
To sell it?
Yeah, that's
they
it.
Buy it and they sell it over the border.
Yeah,
right?
they sell it or they use it for themselves, whatever, right? But I think the arbitrage on milk powder price is pretty much gone, yeah. Or they come and buy the iPhone, the one that I have, the new one I like, the rose gold.
Can I,
right, that's it, yeah.
I'm not going to test you, obviously. Yeah. But I was reading recently, so in 1997, 98, they cut rates to help the economy, China. 2008, that crisis, they cut rates. They did not devalue the currency. That is why there's a lot of panic. So by cutting rates, the reserve requirement ratio and interest rates and devaluing the currency, surely, and many are talking about the real growth in China is 3 to 4%. That I've heard business people who are in China say it's actually not even near 7%, it's half that. So those people who are concerned about the devaluation, the rate cut, the RRR cut, and also this concern about the real growth, what do you say to them? There's some could be in the audience who are very concerned that actually the real situation is far worse than we're hearing about.
See, this is a challenging part, right? We have a feeling that GDP growth may not be quite as high as 7%, but no one has a shred of evidence to say it's 3%.
I'd like to see and cutting rates together, by not doing it in 2008, not doing it in 1998, right. That implies that there's a bit of panic going on. They're doing everything they can to shore up the slowdown. But
on the other hand, you can always say that they have a lot of scope to cut rates, because rates back in 97, 98 is a very different situation from today. Back then, the US economy was booming. Europe was not in trouble at all. But now, you've got a challenging global environment, right? And rates globally are zero. I mean, if you have a bank account in Hong Kong, you get 0 interest. You have a bank account in America, 0 interest. You buy the German bond, you could be paying the bank to buy the bond, right? Because rates are negative or 0. It was not the case back in 97, 98. So Chinese interest rates still could come down because it's not at 0 yet. And also the so-called reserve requirement, these in banking, in the financial circles, we always talk about reserve requirement. People say, what is that? But people don't really ask, but I want to explain what that is, okay? Reserve requirement ratio. How many people know what that is actually, what that means? See, very few people, the financial practitioners know. So we should.
You didn't ask me, that's all that matters.
Oh, so what is a reserve requirement
I don't know.
ratio?
it's the bank lending rate.
No, John, come on. You're the Bloomberg anchor.
Of sorts.
So it's very simple. It's called, so on TV, he doesn't even pronounce, he said RRR, triple R.
No, I read it out as well, reserve requirement ratio.
Yeah, so reserve requirement ratio. On TV, on Bloomberg TV, you turn it on, triple R.
It's the bank
so the average person, what is triple R?
It's the bank reserves and what you lend on.
No.
Right.
So what that is okay, okay, John, I'm the bank, you're the customer, okay?
Yeah.
So you come in, you have your monthly salary, you have $100 left. You deposit, you come to the bank, and deposit your $100, right? I, as a bank, take in $100. I then have to put part of that on reserve at the Central Bank of China, PBOC. That money I cannot lend out. So what happens usually is the banks want to have liquidity. I welcome your deposit, then I can turn around that deposit and lend it to a customer and make what's called the net interest margin. It's called the spread, NIM, net interest margin. But in China, there's a ratio which is very high. Right now, it's still 18%. So you come in, you give me $100, I have to put $18 aside at the central bank. So that's on reserve, I cannot touch. How much money do I have left after the $18 is taken away?
This is a nightmare. Jing, you're a Harvard English graduate, right? I'm a University of London English graduate. I'm just going to shut up now. Ask someone else. Ask Seth. Ask Gareth. He's a CEO.
So $18.
There's
how
two
much
CEOs there, Gert and Gareth.
Okay. Maybe we'll ask the Deloitte folks. 82.
Right,
That's
82.
right. 82, right? So I have 82.
I'm not going to give an answer. I actually had that in my head, but I didn't want to say it.
I think AmCham fed us too much
and
lunch.
I think lending in reserve, I also said. I just didn't explain it as well as you did. Right, I know.
So $82 left. I can then lend that money out, right? So the reserve requirement is set by the central bank. If I want the bank to lend more money to customers, I cut the reserve ratio. If the ratio is cut to 10, I can lend out $90, right? So that provides more liquidity into the economy. So the ratio was as high as over 20%. So the central bank was in China tightening monetary policy, tightening liquidity. So a lot of the money basically was parked away on reserve, right? But now the central bank, in times of slowing growth, can cut the reserve requirement ratio to let the banks lend more, providing more liquidity, and get economic activity up. It's as simple as that.
They've done that and cut interest rates and divided the yuan.
And they could do even more. They cut interest rates 5 times already since last year. They cut the reserve requirement ratio 4 times, and they could cut again sometime in the second half of this year because the reserve ratio is still very high.
I'm very aware of time. I want to get to the reforms and also Q&A. Quick question, if I can just deviate on interest rates in the US. So do you believe that the Fed has pushed themselves into a corner? As you quite rightly said, there's no room to cut, that they simply want to raise it so they have that room later on. Because right now they're trying to raise it by a quarter point, which is small, obviously. But there really isn't the evidence to show that they have that space.
Well,
to raise rates.
It's been an ongoing debate, right? Whether you can actually just check, kind of take the pulse on the market. Every day, Bloomberg, CNBC will tell you the investment community thinks the Fed will raise rates or not raise rates. What percentage of people thinks this and that, right? So what happened was at the September Fed meeting, they decided not to raise rates. So rates were kept steady. And then in the recent couple of weeks, the U.S. economic numbers have come in slightly lower than expected.
Yeah.
Jobs numbers and other economic numbers, PMI numbers and so forth. So therefore, now by and large, I think the majority of the people think that sometime in 2015, we may not actually see a U.S. rate hike. But Fisher, who's a Fed governor, on the weekend said, oh, we could still raise rates, right? So you have different schools of thought, different contending opinions. So interestingly enough, emerging markets, of which China is one, Brazil and Russia, et cetera, right? Indonesia, India, all these emerging markets are really watching the Fed action very closely. Because if you think about it, if the US rates go up, what happens? More money will go to the US, right? Because money wants to find a home where you have higher returns. That could take money out of the emerging markets, particularly countries that experience current account deficits, meaning they export less than they import, right? So when they have current account deficit, when money goes out, you're gonna have a big problem with your currency, right? So recently, as people's expectation for Fed rate hike in 2015 diminishes, emerging market in the last few days actually did a little bit better because people, oh, gee, let's breathe a sigh of relief, gives us a few more months, So eventually, rates have to go up. The norm is not to have 0 interest rates, right? But right now, the Fed is looking at slightly weaker economic numbers, but also there are no signs of deflation, no signs of inflation anywhere, right? The Fed is always watching inflation very, very closely, but there are no signs of inflation. There's deflation everywhere, or disinflation. Yeah.
I want to go to the reforms, but quickly.
Okay.
The China slowdown and what you just said, the ASEAN countries, which ones will lose out the most? Which ones will be hardest hit? Obviously, Indonesia, for example, those that export or rely on China,
Right.
Commodity-strong economies. But how bad is the fallout for Southeast Asia?
Well,
From China?
I was just talking to our friends from the port business over there. If you look at trade, there's a bit of trade recession going on because trade numbers anywhere in the world are not looking very promising, at least for now. And if you look at China, which is a gigantic 900-pound gorilla here, you really have difficulty. Think about, China is the single largest trading partner for all Southeast Asian countries. Used to be the US, as Malaysia or Singapore exported so much to the US, but now China is the biggest customer for all the Southeast Asian countries, but also Japan and Korea. So China imports palm oil, soft commodities from Malaysia, auto parts, electronic components from Thailand. China imports a lot of coal, a lot of bauxite. Do you know what that is? What is that, bauxite?
You use it to make iron ore, no? It's used to make iron ore.
Wrong.
Oh, magnesium.
You're doing a completely
It's
different metal.
It's a disaster. This is a disaster for me. Credibility
Bauxite
shot.
is a raw material
it's
that
used
goes into
to make
alumina.
Okay, alumina.
Alumina is different from aluminum.
I should know that. I actually do know that. I feel stressed.
Alumina then is produced
Being
into
grilled
aluminum.
by Jing Ulrich. It's not fun. Okay, back to you. Back to you. So Southeast Asia. So bauxite or car parts,
yeah, because
etc.
prices have dropped so much, right?
Yeah, of course,
Thermal coal is in a lot of trouble.
Which areas are going to really feel the heat?
Well, see, all these areas. So if you're exporting commodities to China, you're definitely suffering. And also, as China gets more environmentally friendly, environmentally conscious, it's using less thermal coal. It is, we're talking to our friends from CLP here. They're going bigger into the renewable area, right? They're trying to clean the environment by using more wind, more solar, and natural gas, which is cleaner than coal. So all these countries are affected by that. But the brighter spot is, guess what?
Don't tell me.
What?
Oh, Seth.
What people?
I'm not going to say anything.
It's what people eat. Okay, the middle class. We talked about consumption.
Pork, chicken, right?
Well, they eat a lot more protein, right?
Pork or chicken.
Yeah. So
that right.
Beef, chicken, pork, and Australia is a big beneficiary of all that. Dairy products as well. New Zealand, right? As the diet changes in China, the middle class really needs a lot more protein, meat protein in particular, and so Australia is exporting a lot of beef, a lot of cattle to China. That's a big, definitely a big beneficiary of this trend.
Final question before we go to the audience. It's a 13th five-year plan in 2 weeks' time. 26th to 29th, the last 12th year, they've achieved most metrics. This is a very different scenario going for the next 5 years, obviously. What should we expect from the government? Obviously, they're going to fill a few senior posts that have been removed or gone quiet because of the anti-corruption crackdown. But what should we expect from this next? Obviously, reforms is the key.
Yeah, so you're referring to the 5th plenum session of the 18th Communist Party Congress.
Yeah, the 13th five-year plan.
Yeah. So what's happening, the plenum, we have the first plenum, second, we had four plenums already. So the 5th plenum is coming up at the end of October. They just announced the dates yesterday, I believe. So the 5th plenum will be actually designing the next 5-year plan, which begins in 2016. So March of next year at the National People's Congress, you have the premier officially announce the whole blueprint, right, for the next 5 years. So as you said, John, correctly, this coming 5 years will be much tougher compared to the last 5 years. The economy is in rapid transition. The global environment is becoming much more challenging. The middle class is more demanding. They're better off, but they want a higher quality, much more sophisticated, absolutely. So I believe the priorities will be the following for the next 5-year plan. Number one, maintaining high quality of economic growth. Not high growth, but high quality economic growth. So this goes back to my original comment about consumption becoming the most important driver. The Chinese leadership wants growth to be much more sustainable. Rather than driven by investments, they want growth to be driven by consumption and the service industry. Number two, the leadership will be incentivizing service-oriented, and high technology industries. So the economy will be driven by consumption, but not only consumption, but also innovation, high technology, boosting productivity. The third part is ensuring timely implementation of financial reform. We all know financial reform is so critical to the overall economy because that's the foundation, right? So when you think about financial reform, that basically includes not just the currency, but also exchange interest rates, both lending rates and deposit rates, but also how to create a level playing field for companies, big and large, foreign and domestic, making sure they all have adequate access to capital. And financial reform also includes capital market reform, including IPO reform. And then fourth is promoting infrastructure investments to help the continued process of urbanization. Urbanization rate today is already quite high. You know, what is it today, John?
I don't know, but I can tell you that the rural area is still suffering. The poverty line is extremely high.
So urbanization rate today...
That needs to be addressed. Wasn't addressed in the last reform package.
Yeah. So urbanization rate today is
that's
54%. Yeah,
yeah,
54%. So that means over half the population now lives in the cities. But back in 1978, when Deng Xiaoping kicked off the reform program, what was the urbanization rate then?
I've absolutely
78.
no idea.
Were you born
No.
then? 78?
No.
Not yet. So I forgive you. So that year was 17%. So 17% back in 1978. Now it's 54%.
Right.
And this 54% will not stop here. It's going to go up to probably 85%. So every year you have 15 million people who are transforming from an agrarian lifestyle to more of an urban lifestyle. You know, leaving the farmland, going into factories, going to service jobs in the cities, right? So the leadership, this requires a lot of infrastructure investments. So they need to build infrastructure, not just, you know, airports and high-speed rail, but also just plain roads and, you know, MTR stations.
Housing.
Yeah, housing, yeah. And then finally, it's basically balancing China's growth with environmental concerns. We all know how important that is. Yeah. So these, I believe, are the 5 priorities for the next 5-year plan.
Thank you very much indeed. Q&A, please. Not to me, to Jing.
Since I'm sitting up front.
Lily, sorry.
I'd like to ask the question here. It's on One Belt, One Road's impact on China as well as the rest of the countries that may be involved in One Belt, One Road, and who are the winners and losers of One Belt, One Road. Thank you.
Okay, so One Belt, One Road, 一带一路. So what this means, actually, let me first clarify, One Belt, One Road. Do people know what that refers to, belt and road? Belt and road.
Lanes?
Where does the belt go? Where does the road go?
I'm not even going to try and answer the question because I do know what it means. I'm just going to be quiet.
Actually, it's a bit of a misnomer. The belt is a road. The road is a maritime Silk Road. Yeah. So the belt goes from central China, you know, Inner Mongolia, Outer Mongolia, to Kazakhstan.
Kyrgyzstan.
There are 5 of them, right? Uzbekistan, the Stans, right? Yeah, and he says he knows all the Stans. That's very good. Your geography is good. And then Belarus, Russia, and all the way to Europe and down to the Middle East and Africa, Northern Africa. So that's the belt. The road is the new maritime Silk Road. It goes from Southeast China to Vietnam, to Burma, Thailand, Burma, and then the subcontinent, the Middle East, and then somehow, I guess, the Belt and Road converge in northern Africa, right? And this whole area covers 65% of the global population. And it's a very ambitious vision by Chinese President Xi Jinping. I think the idea, actually the goals he set, one was to lift poverty of the entire region, and second is promote trade and promote infrastructure investments. These are very lofty goals that no one can criticize. They're absolutely the wonderful goals to achieve. Now, so I think what's going to happen is also China. Think about it. Some people say China wants to export the excess steel, the cement, to the surrounding countries. But we all know cement doesn't travel very well. You know, you can only, how much cement can you export? How much steel can you export, right? But I think what China wants to do is to export capital, not just physical goods. and engineering expertise. So if you think about it, China builds the best high-speed rails anywhere in the world these days. So they will export the engineering expertise, maybe some materials, but I think that's going to be limited. But also they created the Asia Infrastructure Investment Bank, AIIB, to provide financing for these infrastructure investments. So I believe in the coming years, you will have a lot more infrastructure construction in all these different countries, right, covered by One Belt, One Road. But China also will be in the very advantageous position to get more raw materials into the country, including natural gas and oil, not via sea, because the Malacca Straits it's a choking point, right? If that's blocked, China's oil cannot get through. So if you build more pipelines over land, more gas, more oil can come from Russia, for example, and other producing countries in that area. Also raw materials, and China also wants to find alternative routes to get to the sea, right? Burma, for example, will offer quite an attractive alternative. So I think the One Belt, One Road initiative overall, it's a very strategic vision, but I think also in the coming several years, you will begin to see some real beneficiaries. Clearly, infrastructure companies, high-speed rail construction companies, companies that have engineering expertise, and banks that will provide capital to all these large projects in the future.
Lady at the back. And then after that, Gareth. Just lady at the back. Ladies first, gentlemen. And then...
Thank you. My question is about the role of the market in China. In 2013, at the third plenum, China vowed to let market forces play a decisive role in the economy, and that accompanied SOE reform. 2 years since the August events with the stock market and also the currency market, how would you evaluate the role of the market, the invisible hand versus the visible hand in China?
Stacy, that's a very good question. You're absolutely right. At the third plenum 2 years ago, in November 2013, the leadership really enshrined the role of the market in the economy, really giving the market the most critical role it's ever given. Now, in practice, of course, it will take time. We all know the Chinese economy is a top-down economy, and the leadership is very involved in the day-to-day business across all different industries. So I think in some areas, they've been trying to give the market a bigger role, but in other areas, they've actually tightened control. If you think about it, right, the currency, I think this move on August 11th actually was very much the intention was to give the market a bigger role. But perhaps because of the communication, something was lost in translation. The stock market players didn't think that was the intention and quickly sold down the currency, right? So I still think the leadership wants to drive the economy more towards a market-driven model, but it will take some time. Because if you think about it, right, you have a lot of the private enterprises doing very well. They're purely, they're not just surviving, but thriving because they're very close to the market. They don't really receive preferential loans from the government. They basically are succeeding based on their own hard work and their good business instinct. So I think in the future, hopefully during the fifth plenum, the leadership will re-emphasize the importance of the market. I'm thinking about financial markets, for example. You cannot control stock prices. No one can. Stock market prices are determined by supply and demand, by buyers and sellers. Just let it go, and eventually the market will find its own equilibrium. So I think we're still in a bit of a tussle here between kind of the invisible hand of the market and the visible hand of intervention, right? But eventually, I do think, I'm a firm believer in the role of free markets, and I really think it will win out eventually, but it will take some time.
A question from Gareth. Just quickly, I heard this wonderful rumor, not wonderful, but it's a rumor in the world of journalism, that when the central bank released their statement in Chinese, somebody translated it into English and mistranslated a couple of words, which obviously in central bank speak is very dangerous. That was one of the rumors that triggered a panic sell.
Well, I think just the overall communication.
Well, it's not true, it's a rumor.
Yeah.
But,
So that's why, China still remains
so
a bit
someone's
of
out of a job, I guess.
Well, China is still, to the outside world, China is still a bit of a mystery, right? Because the language is difficult.
Particularly that central bank speak has got to get it absolutely, intonation.
Well, there are lots of central bank tea leaf readers, right?
Exactly.
Around the world.
Or Fed, obviously.
Fed and ECB. I think the Chinese central bank, the same thing, is being more closely watched than ever before. So I think communication is so important to the market these days. Otherwise, also I think the Chinese leadership needs to really appreciate how much their actions are impacting global markets.
Yeah.
China is no longer a small country. China is, $11 trillion today in terms of the size of GDP, but it's contributing 35% to global growth. And it's remarkable. This year, China is adding another $1 trillion to its GDP, right? The US is adding 200 billion. Europe is adding 130 billion.
Some would say China's already the biggest economy in the world.
Its
I know the World
impact,
Bank has at number 2, but some say that actually on different measurements.
On a purchasing power parity basis, you could argue China is already the biggest. Whether it's number 1 or number 2 is not exactly relevant, but it's the most important thing is that in terms of contribution to global growth and the impact on the rest of the world, China indeed is number 1.
Gareth.
Okay, my question's to Jing. So, John, you can sort of breathe easy, so no problems.
Thank you, Gareth. He's Welsh, sorry. He's in the rugby. England are out. I'm very embarrassed. Look at his smile.
I'm a happy guy, so this is okay. Jing, I think much has been made about the need to move the economy, the basis of the economy towards consumption. Some may argue that the government has really not done enough in terms of policies to promote this. I think maybe a small indicator of that is if we look at savings as a percentage of disposable income. I think in the US it's around 6% of disposable income is saved. In China, it depends what numbers you look at, but it's certainly around 35 to 40% of disposable income is still being saved. What do you think the government can do to really promote consumption and free up what is essentially a huge amount of money that's been stashed away?
That's absolutely right, Gareth. The pool of savings in China right now amounts to $20 trillion. $20 trillion. This is the biggest pool of savings anywhere in the world. Japan has 12 trillion. So that's a distant second to China, right? So that's why we mentioned earlier, when you have the bank reserve requirement rate being so high, 20 trillion, 18% of that is actually on reserve at the central bank. So they could unleash a lot of that, to the banks to have them lend more. But how do you change consumers' behavior and their habits? If they don't save 40% of their income, if they save only 20, there will be a huge boom in the consumer market, right? I think the reason why people save so much is because there's no social safety net per se. So when they retire, there's minimal pension. They need to use their own savings. When their children grow up for education, education is getting much more expensive. Healthcare is an issue as well. So I believe if the Chinese leadership puts more money into the so-called soft infrastructure areas, not just building highways and tall buildings and airports, but putting money into social security, what I call soft infrastructure, that will really help people worry less about their future. So therefore, they can feel free to spend more and save less. The other issue, I think, Gareth, what they can do is promote capital markets and educate investors so that they can generate more returns on their money. So the $20 trillion of bank savings in China are earning literally nothing. Interest rates are very low. Capital markets, as you know, we've had a very, very big gyrations in the last 1 year. This time last year, the index was at 2,000. It went to 5,100. Now we're back down to 3,000. So people, long-term, savers don't think that the stock market is a good, sustainable way to generate wealth and create returns. So if the central government promotes capital markets, let more diversified financial products into China, so that savers generate more than 25 basis points on their savings, that could also help them have more confidence. Because if you think about it, Gareth, you're a smart guy, you're a CEO, but not everyone in China is. These are retirees. They may just had 3 years of high school education, but you don't have to be a rocket scientist to know how much money you would need when you retire. Everyone has a target in mind. Everyone in this audience has a target in mind. When I retire, I need this amount of money to live out my years. So everyone tries to get to that target, right? In China, it's the same. So these retirees will think, gee, you know, I'm 50, I'll be retiring in 5 years' time. I need this much money in my bank account so that I have a comfortable retirement life. But then I'm not generating the money from my bank savings. What do? I save more and more and more and more. So they're forced savers, right? But if I can generate 10% returns on my money, I can save less. So in a way, it's a psychology at work here. If people can generate decent returns on their investments through diversified financial products, they can then save a bit less. If they manage their own wealth well, they don't have to save all that much, right? But at this point, you know, there are very few financial products available other than bank deposits, maybe gold. People kind of lost interest in gold as well. Property, that's it.
The savings rate's
right?
so low.
Yeah, so I think one is to build soft infrastructure. Secondly, is to really develop capital markets and let more diversified financial products be accessible to Chinese individuals.
Time for a quick question. I know it's 5 past, you have to go to a board meeting. Anybody, I want to go this side. Gentleman over
Last
there.
question. I have to
Last
rush.
question. Sorry.
Okay, thank you
Ask
very
her, she's leaving.
Thank you very much, Jing and John. Great presentation. I remember in the global financial crisis in the U.S., Warren Buffett stepped up to the plate and went all in on the U.S. economy with Burlington Northern Railroad when he bought that. And to me, that sent a strong signal to the man in the street that things were not as bad as they seemed, and that there was someone very famous that went all in, as he said. And in China, you've read the numbers where there's a huge capital exodus. And you've also seen guys like Jack Ma and some of the other billionaires, Wanda Dalian, et cetera. They've been on a buying spree outside of China. And I'm just wondering if you think if we need a Warren Buffett of China to do something similar in China at the moment.
Well, I think, you know, Warren Buffett can sway public opinion. He also said famously, I'm greedy when others are fearful. I'm fearful when others are greedy, right? And I think that's something which we should all keep in mind.
A contrarian.
Yeah, a contrarian. Yeah. But I think in China, I don't know such one person that commands kind of the public respect the same way that Warren Buffett does in America and globally, right? And you're right, you know, Chinese investors, especially the elites, are investing increasingly overseas. They're really diversifying their assets, which makes sense, right? At this juncture in China's economic growth, when China is the second largest economy in the world, companies are going more global, is actually a good thing, not a bad thing. But onshore in China, there are very few things for individuals to invest in, right? You know, you have very few financial products available. So I think in the longer term, there needs to be more investor education. You know, some of the more diversified products that are available to Hong Kong investors, US investors, should be made available to mainland Chinese investors. I think that's happening. You've got something called the mutual fund recognition between Hong Kong and China. So in the future, you know, my colleagues at JP Morgan Asset Management or BlackRock, they could, you know, channel some of their products to Chinese investors on the mainland. So I think eventually this will work. But again, it will take some time for investors to gain the confidence and sophistication to invest in more complex financial products than just bank accounts.
She's waited 8 times on television to ask me questions like that in front of a live audience, and now we're covered.
You did very well.
We're even. I'm going to research bauxite.
Yeah, research
thank you,
bauxite.
Jing Ulrich, honestly, thank you so much indeed for being so candid and fantastic as always.
Thank you. Thank you very much, everyone.